Okay, for the Friday session, the market sold off with the jobs report. The Dow is down 220 points, down just under 0.5%, closing at 45,400. The S&P was down 0.32%, recovering off the lows of the session. The S&P closed at 64.82, rounding up. The Nasdaq was flat. It had been higher. And then we had the Russell. The Russell was up 0.5%. Well, the rest of the market was down. And while the S&P was down, so was the VIX. The VIX was down 0.78% to close at 15.18. Now, we got the jobs report before the market opened. After bouncing around for the first few minutes, had a rally, and the stock market opened higher. Had a gap and trap on the intraday charts. We rallied higher and then we sold off sharply. Distribution was taking place into the rally. I talked about on Thursday, the stock market was looking for a Goldilocks number. Not too hot, not too cold, but just right. Just weak enough to where the Fed would start cutting rates, but not be so bad as to show that the economy is weakening. We are now seeing a deterioration in the labor market, which is a massive warning that recession is about to happen. This is why I have continued to warn that Powell should be slashing rates because we're moving into recession. Now, Trump wants him to slash rates. He thinks that's going to move us into this golden age, and he's going to be really disappointed because it's not. Recession indicators are warning we're going to have a recession, but we got a weak number. We got a weak number for the jobs report for our current August number, and then the previous 2 months were very troubling. I'll show you in just a second, and here it is. We had a weaker than expected August number that came in at 22,000. The July number was revised upward by 6,000 to 79,000, but the June number, which had already had a sharp revision downward, was revised to a negative number, negative 13,000. It was revised down. The June number was revised down by 27,000, showing a net loss of 13,000 jobs. 22,000 we got this month. We were supposed to come in at 75,000, which was still on the weaker side. This was a very weak jobs report, and again a huge warning sign for recession. If these numbers are correct, and that's questionable, knowing the Labor Department and their history putting out bogus numbers, if they are correct, we're seeing a rapid deterioration in the labor market. But a huge miss on that August number, 22,000. It's expected to come in at 75,000. We were lower than the previous month of 79,000. That was revised upward by 6,000. But then June was a negative number. And remember, we already saw June sharply revised downward last month, and now it's gone negative. You need to be watching these numbers to see if there's any improvement, if they get revised back upward, or do they remain very, very weak, which they're remaining very, very weak. This is all now opening the door for the Fed to go ahead and cut in September. I told you if the number came in strong, they saw the previous months try to get revised back upward, that maybe the market would think Powell wasn't going to cut, and the committee. I talked about this Thursday. I talked about this earlier in the week. We got a strong market number. The market could sell off that the Fed's not likely going to cut. And if we got a weak number, if we got a really weak report, a really cold report rather than a hot report, Wall Street was looking for that Goldilocks just right number. This was really bad. Concerns about recession. Now, we're going to get the inflation data next week. If inflation continues to rise, as I've been predicting from months ago, the CPI had bottomed. It was going to rise. I was right about that. And again, with the weaker jobs report, then you have the risk of stagflation. I think we're eventually going to get a deflationary bust, and I think inflation will rise, move into recession. The inflation will still rise, just like it did in 2008. 2007 on into 2008, and yet the Fed was slashing rates because they finally realized their fairy tale of a soft landing wasn't going to happen, which it is a fairy tale. It's a myth. It doesn't exist. It's made up. Times that they claimed that they have the soft landing, we were still in an economic expansion. But the Fed wants to think their policies actually work when they don't. Everything the Fed does leads to a negative outcome. Everything. This time will be no different. The jobs going negative is a warning sign, breaking now 52 consecutive months of job creation. The unemployment rate ticked up 4.3% from previously at being at 4.2, came in line with the estimate. Now, the president has put a lot of pressure on Powell to cut. The president wants 300 basis points cut. This jobs report, we could see more. The president wrote after the jobs report, Jerome, too late. Powell should have lowered rates long ago. As usual, he's too late. I do agree with the president on that, but for different reasons. I think that we're moving into recession and that Powell should have been slashing rates long ago. As I've continued to say, the Fed has been hawkish right now when they should be dovish. Back when inflation was rising to 9%, they were dovish, telling us inflation was transitory when they should have been hawkish. The Fed does everything backwards. And they try to tell us how wonderful they are, and they saved us all from the Great Recession and the housing, all this stuff. And again, their policies caused this stuff. Again, the Fed has completely lost their way. I'm no fan of the Fed, and their policies always lead to a negative outcome, always. Our first negative number in 52 months. But the one that we had last was back in 2020. Last negative number that we had. We've seen deterioration in the labor market. It is job creation is declining. Okay, and we have not only deterioration in the labor market, but now it's rapidly accelerating to the downside. The last 3 months, again, this month, the 22,000, very, very weak number. July was revised up 6,000, but only to 79,000. And then June, we've gone negative. That's a huge warning sign when you go negative. If that number does not end up getting changed and there's constant revisions. The numbers you see here are actually much, much better, but the Labor Department overestimated the numbers by hundreds of thousands in 2023 and 2024. So the Labor Department's numbers have been untrustworthy. And that's why I told you I didn't know last month what would have become of these numbers. And I still going to be watching. I look at this stuff carefully. And I told you last month, are we really getting weakness, or is this just more accounting tricks from the Labor Department? I told you I had no idea. We're seeing some real weakness. If this is true, it's a massive warning sign that recession is going to start in just a few months. Now, the good news, I have some good news for you, is we're likely going to see improvement at some point with the jobs numbers, and it's going to get really bad, and it's just going to go negative and stay that way. Now, I'm going to show you what happened in 2007 and 8. Now, this is the negative number, negative 13,000 right here. That was revised down. It was a positive number. The last two revisions sharply revised down last month, and then down 27,000 this month to take it into negative territory. That holds. Again, it's a huge red flag, a huge warning sign. But eventually, we could still buy a little bit more time. We could still see reports possibly come in positive, maybe even strong, just before the recession hits. And we'll be watching to see, do we get further weakness with negative numbers? So I have some good news for you and some bad news for you. The good news is the stock market is likely going to go make new highs once it corrects. The bad news is that if we are now getting this rapid deterioration in the labor market, it's likely we're going to see it improve briefly, but then it's going to eventually get worse. That's what we saw in the latter half of 2007 on into 2008. This is the job creation from January to December in 2007. The initial number is over here, and then the revision, the revised number, final estimate is over here on the right. This data is from the BLS website. Now, we had positive numbers from January all the way down until we got to August. In August, we had a negative number, a smaller negative number of 4,000, but it was a negative number, very similar to the negative number we just got, 13,000, negative 13,000 for the June number. That was followed by September, which was reported in early October, and it was an even bigger number of negative 159,000. That eventually produced a top in the stock market in October when we got the jobs report in early October. This negative number that we got in September, eventually we got that on October 5th. 4 sessions later, on October 11th, the stock market would peak. Now, this is also when we had already gotten the news of subprime mortgage crisis earlier in the year. Market initially shrugged it off and kept going higher. But this negative data in the labor market, coupled with banks starting in October, early October, right before the jobs report and right before the market peaked, we got write-downs from banks. They were banks like UBS and Citigroup and Merrill Lynch began to report significant subprime mortgage related losses and began to take large write-downs in the billions. So while the story broke much earlier in the year, the market shrugged it off. It began to show up on Wall Street in the banks. Later in 2008, we would get the Lehman moment. So we had that whole thing going on with the subprime mortgage crisis, which would eventually blow up into a much bigger financial crisis. And we started seeing the evidence of a recession with the negative numbers, the warning sign with the jobs report. After the release of this big negative number, we still had a negative number, still went to new highs. It was a smaller negative number, like our negative 13,000 that we just got. But the reporting of this September number in October, on October 5th, 4 sessions later, the market would top with an intraday high. 2 sessions later, it would get the record closing high. And then on that Thursday, on the 11th, following October 5th, Friday, October 5th, with this data, we would see the stock market peak 4 sessions later. Right after this, in the latter half of October, right after the stock market peaked on the 11th, from the 15th to the 30th, is when a lot of this stuff was happening. These write-downs and these massive losses were being reported with some of the major banks. I still think we're going to sell off. I think we're going to recover and go to new highs. Even with the negative number that we got in August, we still recovered and we still went to new highs. That was in September. We got that and we still ended up recovering and going and making a new high in October. In the following months, we still got positive numbers. In October, 166,000. November, 94,000. December, we got 18,000. That was later revised down to a negative number of negative 25,000. But we had positive numbers that still followed. Now, it doesn't have to play out the exact same way. We don't get the necessarily the back-to-back negative numbers. Again, we could still see some positive numbers. I'm just telling you, eventually we got a big negative number and it led to a top. If we see a recovery in the labor market, again, we could still go on for a few more months. I believe that we will. I believe we're going to correct, and then I think we're going to go on the final climax rally, which I believe will be the final phase, the final climax rally of the final phase of the blow-off top. I think we're in from the April low, the final phase of the blow-off top. I don't think it's done yet. We're getting the warning sign. Eventually, again, we got these positive numbers. We got the negative 4,000 in August. We got a bigger negative number in September. Got some positive numbers after that. The Fed was still in denial, and basically the stock market peaked in October. It began and it crashed by 20%. We'll likely see something bigger than that this time around. We actually get the top, and then the Fed was still worried about inflation when they should have been worried about the recession. They should have been slashing rates. They weren't. It caused them to do jumbo cuts come January, and we started seeing the December number came in weak. Eventually it went negative, but the December number came in weak. And then after that, we never got another positive number all throughout 2008. This is the 2007 job creation and losses. Here is the data for 2008 from January to December of 2008. This is the job creation and losses for the entire year for 2008. And again, we don't have one negative or one positive number. They're all negative. It followed that negative number that we got in August of negative 4,000 in 2007, and then later the bigger negative number, followed by a couple of months of positive data, is a warning sign. Once we saw the positive job creation end, which we just saw this report right here with the revision downward for the month of June down to negative 13,000. Once that happened, that warning sign, if that number is not changed, the recession followed just a few months later. Stock market top occurred shortly thereafter. We got the August number in 2007 in September. Stock market peaked the next month after that in October. Now, it may go a few months longer. It doesn't have to go the exact same route it did in 2007. And again, the negative number that we got right after the week number, seeing that, we got the negative 13,000. We got the negative 13,000 in June. It was followed by a positive number and then another weak number. As what I'm telling you is that eventually, if that negative 13,000 holds, eventually we're going to get a larger negative number in the coming months ahead that will eventually usher in the recession and likely produce a stock market top. So you've got the warning signs going on here. Follow the negative numbers in 2007, the smaller negative number of 4,000 in August, the bigger one that followed in September. Got a couple months, October, November, December, a couple months of positive numbers. But what followed is that in every month in 2008, every single month was a negative number. And we began to see thousands of jobs being lost, and these numbers were later all revised. Every single number was revised to a much worse number. That's the Labor Department for you. Again, sometimes by more than 100,000. The 17,000 in January, 127,000. The 63,000 in February, 175,000. Negative numbers. Negative 175,000. 20,000, negative 20,000, negative 160,000, so on. And by the end of the year, hundreds of thousands of jobs a month were being shed. The 84,000, negative 84,000, ended up being revised to 175,000. And these numbers, negative 159, negative 240, 533, negative 533, negative 524, all of these numbers ended up being revised lower to much worse levels. That's BLS for you, by the way. This followed what we saw with that negative number that we got in 2007, in August of 2007, the larger number in September, and eventually in January, which was right here, the Fed panicked and they finally realized their soft landing fairy tale wasn't going to happen yet again. It never does because it's a myth. It's made up. It's phony. Time the Fed claims that we had a soft landing, we were still in an economic expansion. The rate cutting campaign was part of the larger cycle, but they want to believe that they can actually micromanage the economy when, in fact, their policies are destructive and lead to negative outcomes in the economy every single time without fail. The Fed has lost their way. They focus on things that have nothing to do with the economy. They're like Mr. Magoo. They can't see what's right in front of them. A huge warning sign. The number remains negative. A huge warning sign, and they have revisions, constant revisions, because they're so off. And here, again, even their bad numbers ended up getting revised to much worse numbers. What we've seen over the last 2 years, to almost 3 years with the recent data has been the worst of the worst I've ever seen, and I've been looking at this stuff for, decades. The numbers in 2023 and 2024, way off. We're seeing that pattern repeated here in 2025 if these revisions downward are correct with the current jobs report and the recent jobs reports that we've had where we've seen these revisions, sharp revisions downward. This is warning, a huge warning sign. Recession is coming. Now, we did see mortgage rates saw the biggest one-day drop in over a year with the jobs report that we got. So again, real concerns now that the economy is weakening and that we're going to get the rate cuts out of the Fed. But as I keep saying, it's going to be for the wrong reason, not because the economy is good, but because the economy is moving into recession. Now, the current target rate is 425 to 450. The 92% chance that moves from 400 to 425, a quarter point cut. The small probability that we didn't get a September cut has gone away completely, and now we have an 8% chance of a 50 basis point cut in September. No Goldilocks jobs report. Told you it was if it came in hot, the market would not like that. Came in strong, we believe the Fed would not cut, and if it came in weak, as we've gotten, then the belief is, yeah, we're going to get a cut out of the Fed, but the economy is weakening, and that evidence from the rapid deterioration in the labor market. This is the Fed Fund futures. This is the betting markets. This changes all the time, but right now it's at 92% that we get a cut, a quarter point cut in September, and it's now expected that we'll get another quarter point cut in October at the October 29th meeting. 72.6% chance there, 92% chance again in September. But now there's a third cut possibly on the table that is higher than 50% at 67% for December. So this has now gone back to three cuts of greater than 50%, one for September, one for October, and one for December or January. Eventually, again, all of this is the probabilities based on the betting markets. Again, eventually we're going to get the jumbo cuts out of the Fed, where they're going to do a meeting where they do half a percent or 0.75%, and then they're going to do that and do even more, and they're going to do it surrounding one of their meetings. That's what usually happens. Now, if we don't see an immediate top and the ushering in of the recession, we buy a few more months, can sell off, still recover, and go make a new high on the S&P 500, on the NASDAQ, on NVIDIA, on Bitcoin. We'll top out if we start seeing the jobs report start improving and then get a big, ugly negative number later. In 2007, we got the weak number of negative 4,000. We got the horrific number of negative 159,000 the following month. If that's delayed, where we get a big negative number, maybe we buy a little bit more time. It doesn't have to play out exactly the same way it did in 2007, but you did get the warning sign with the negative number that we got breaking. The 52 months of consecutive job growth is now broken. If that number is real and it does not end up getting changed. We do end up selling off in September, but then recovering on into the coming months ahead. October, November, maybe as long as December, could start getting jumbo cuts from the Fed later. They still might be reluctant. What do we have? What's that guy's name? Goolsbee, I believe. He'd be on CNBC all the time before he became a member of the Fed. But he's saying that, again, inflation's still a risk. And I'm telling you, we're going to get this report next week. The CPI report, we're going to get the PPI inflation. If that comes in hot, and the fear is going to be a weakening economy with rising inflation, the fear is going to be stagflation. You got Goolsbee out there saying he's undecided about a September cut. He wants to see the inflation data first, which we're going to get next week. We've had the inverting of the yield curve. We've had it uninvert, and it's going back and forth right now. This is warning us recession is about to happen. We've had the longest inversion in history. This is where the 10-year, between the 10-year and the 3-month, and what this means, the inverted yield curve means when it goes negative like this, below the red line, goes down below zero over here that I've marked right here. Shorter term rates are higher than longer term rates. It means recession is coming. And when you get the inverting of the yield curve, and then it inverts again, and then it uninverts. Usually recession shows up shortly after, the stock market peaks shortly thereafter. We're kind of jumping around back and forth here, but again, eventually, I think in the coming months ahead, I think we will see the stock market peak. I think we're going to get a pullback, and then I think we're going to rally up, and then in the next few months, I think we will see a peak. October, November, December, likely in November or maybe December. The Fed does end up cutting rates. I expect that they're going to go into full panic mode once we get a big, ugly negative jobs number and we see evidence that the market has peaked and begins to sharply decline. That's what usually happens. 2007, I'm talking about the jobs report. It peaked right there. That was the week it peaked. The jobs report was the released that Friday, 4 days before the market peaked the next week on Thursday. We had a close, an all-time high close on Tuesday, 2 days after that jobs report. We had the subprime write-downs by the banks shortly thereafter, and eventually down over here we get the Lehman moment later in 2008 in September. The whole financial crisis was unfolding. But even with our first negative jobs report, we still went to a new high. That first negative number was right there with that red bar right there. We still ended up going to a new high. We had the inverted yield curve eventually uninverted, and then inverted again, and then uninverted. We still went to a new high, but eventually the steepening of the yield curve caused that recession warning to play out. And again, the inverted yield curve and then the uninverting and the warning sign prior to it with it inverting again. All of this is a warning sign recession is coming. The Fed dismisses this stuff. They don't believe it. That's why they are always blindsided by the recessions coming. So I still think we're likely going to see a new high. We had that first negative number here. The August number was reported there in September, and we still ended up going to new highs. Here we had the correction already in July and August. We didn't have the correction in July and August. We had some sell-offs, but the market pretty much went sideways. So we'll likely see that in September, followed by new highs, but eventually a top and followed by something like this, where we dropped 50+% on the S&P 500. After the market peaked and we began to get the subprime mortgage crisis starting to show up in the banks with the write-downs and other things, so the market dropped by 20%, over 20%. This is where we got the Fed doing emergency cuts. They did a 0.75% cut, and they panicked in January of 2022. The recession began in December of 2007. I'm sorry, 2022. The Fed cut in January of 2008. Pardon me, wrong year. And the recession began in December of 2007. The shaded areas where it began gave us a bounce. Other people right now saying, well, we're going to avoid a recession because of the tax cuts. Well, they did that in 2001. It just gave us a bounce, just like we had with the emergency cut with the Fed here. Tax cuts did not prevent the recession from happening, and that's what people don't understand. Those things take their time to work into the economy anyways. We've got the warning signs. We had the inverted yield curve. It's uninverted, and it's kind of going back and forth right now. I just showed you the chart a moment ago. We've now had a negative number with the jobs report. We'll see some positive numbers, but eventually you're going to see a bigger negative number. It could allow the market to peak as it did over here in 2007. We'll be watching that going forward. Coming months ahead, we could begin to see the negative numbers, larger negative numbers than what we just saw in June at negative 13,000. We can begin to see this start showing up as we move into recession.